Hello, everyone. Welcome back to the Ask Avidian podcast. My name is Jake Borbidge, Chief Investment Officer here at Avidian Wealth Solutions. Joining me again today, Robert Palmer, our DFP, Director of Financial Planning. It is, what's today's date? April 4th, right? April 3rd. April 3rd, the Liberation Day announced by President Trump yesterday afternoon.
Couldn't feel more free than I do right now.
Couldn't feel more free, yes. I've definitely been freed from a portion of my portfolio, which doesn't feel as liberating as I'd like it to. But all kidding aside, the markets are not taking the announcement of the U.S. Tariffs imposed on virtually every country in the known world yesterday, with a minimum tariff of 10% and then going up from there. So, Robert, we've got some things to digest. The market is trying to digest this new information, not digesting it particularly well, or if they are, I guess it was a pretty negative surprise. So, just kind of reading the tea leaves today of a very broad-based sell-off, I think, perhaps what the market was expecting was a much more muted initial response to these tariffs. Is that what you're seeing as well?
Yeah, especially yesterday, because we actually saw a bit of a rebound yesterday, a few percentage points up. And then in the aftermarket, right at around 401, I was seeing a few percentage points up, and I got really excited. And then if you wait till 405 after the market closes, all of a sudden futures are down 3%.
Yep, and it's a classic case of buy the rumor and sell the news, although you wanted to sell the news, but a little bit before the news came out. Now, I do think in listening to Howard Lutnick this morning, he had a spot on Bloomberg, which is nice to hear. And then seeing how Trump, displayed the tariffs yesterday, there's a little bit of showmanship. The big, big card that we had with all the all the tariffs of what countries are charging us versus what they're charging, what we're going to charge them. There's definitely some showmanship there. What Mr. Lutnick was talking about this morning was more of a resetting of what they'll call fairness in global trade. Which, to me seems like more of a negotiation mindset as opposed to we just want tariffs for the sake of tariffs mindset. So I think there's a silver lining there from the rhetoric side of things. But definitely I think what the market was expecting to see yesterday were probably either smaller numbers and initial tariffs and maybe more of a stepping up, whereas I think what we've heard from President Trump is that this is the high point and we're going to work our way down from here. Interesting negotiating tactic, right? The first offer should be offensive, which I think they've clearly offended every one of our trading partners with these first offers. However, we can improve from there.
Yeah, and then to your point about there being some deals on the table, I believe some countries have already come to the negotiating table to see what they can do to lower or eliminate some of these tariffs with some reciprocal treatment. And I know that the countries that are currently not willing to come to the table, there seem to be very large companies within those countries trying to reach out to the U.S. government to strike a deal with the administration. So there seems to be some deal making going on, but the markets aren't really reacting to the silver lining right now.
Yeah. So let's talk a little bit about what's going on in our portfolios, our models, and what we're doing as a result of that activity. So I think just kind of initial observations, right? It is a pretty broad-based sell-off, but there are some pockets of relative winners. Number one is Mexico. So Mexico and Canada were actually left off of that big card that the president was holding up yesterday. They have already kind of started their tariff negotiations, the trade renegotiations. So not to say that they are immune from tariffs, but they were not slapped with any additional tariffs yesterday. So I think they're further along the line. So we're seeing those markets, especially Mexico, respond positively. China has been pretty robust, I think, to most of this tariff news. They are also stimulating pretty aggressively in their local economy, so that's helped to balance some of that out. India is pretty flat today, which I thought was a little bit of a surprise because India has very high tariffs on U.S. Goods and services, and so and they were also hit with tariffs yesterday. So to see that market a little bit more flattish, that's a little bit of a surprise. But within portfolios, I think the one thing I would say relative bright spot is the lack or the low correlation that we're seeing between equities and fixed income. And so the reason why I say that was a bright spot is, a couple of years ago we had a sell-off, 2023 in the kind of Q3, I think it was. And it was a very unique sell-off. There was a concern around, I think, a potential recession in the U.S., but we saw equities sell off pretty rapidly and pretty dramatically, but fixed income bonds sold off almost at perfectly correlated to equities. And so the typical diversification, the typical hedge that you would think against that you had in your portfolio against equity volatility did not work. Today, not to say that this is going to be something that plays out, over the entire trade negotiation process, but today what we are seeing is bonds are up, likely because rates are coming down. There's a flight to safety, and bonds are being viewed, at least by institutions and some retail traders, as a safer asset than equities. So reassuring to see that potential hedge come back into portfolios. So your 60-40 is acting like a 60-40 should. Your longer duration bonds are doing well today because they have that defensive characteristic. And then within the equity space, we are seeing defensive stocks, the low volatility basket of stocks, providing some ballast in portfolios. So again, traditional diversification strategies are working today, which I think is definitely a positive. Not going to be something that gives a lot of reassurance in the midst of it, in the throes of this volatility, but just kind of know that is working for your portfolio if you chose to diversify over the last kind of handful of years.
So that's definitely good to know. One thing I want to circle back on, because obviously I think one of the key things that people are focusing on now is, okay, there's some pockets of opportunity here, there's some silver linings, but what's going to happen moving forward given all the turmoil that we're seeing right now? You mentioned that Canada and Mexico were left out of these particular rounds of tariffs. They basically didn't change from where they were prior to the announcement the other day. Given that they're slightly further along and their markets seem to either have turned positive or remain flat, is that sort of prescient in how we can potentially anticipate some of the larger players out there coming to the table and trying to renegotiate the tariff situation? Do you think that this is just the beginning and moving forward we might see a similar performance as people start talking more about how to address these things?
Well, I would like to think so. And so one of the things that we've been saying kind of all along is that uncertainty, markets do not like uncertainty. They don't digest it. They vomit it back up in the form of negative returns typically. And so if you were to kind of grade different countries in terms of the amount of uncertainty, and you would say that Mexico and Canada have moved to kind of the other side of a reduction in uncertainty, meaning that they are closer to a final trade agreement, then yes, the markets are definitely rewarding that that development positively. And if you said, okay, well, just a reduction in uncertainty will help stabilize markets, help stabilize multiples, I think you could make a fair case for that. I think the one nuance with Canada and Mexico, given that they are obviously our physical neighbors, and that they are very close trading partners with the U.S. In a number of different ways, they are highly incentivized to come to an agreement that's amicable for the U.S., being that the U.S. is one of their biggest customers. And I would like to think that we will see some of that activity with some of our other trading partners. However, not all of them, right? And so to the extent that some of our other trading partners see this as a opportunity to negotiate quickly and get past the volatility, I think that is a potential outcome, is that volatility reduces, uncertainty reduces, and markets kind of start to stabilize. Where I think you're going to see some winners and losers, and again, this is just completely speculating because obviously I have zero information in terms of the pace in which these tariff negotiations are going to play out, is that where you see countries come to an agreement quicker, you'll see volatility subside in some areas more rapidly than others, and likely that's going to result in some capital flows. Capital flows into those markets are going to result in some positive rebounds. So we are definitely watching that, but it's something that we're going to be keeping a very close eye on. So
let's talk about worst case scenario that these negotiations wind up being protracted. For the last several months, for the better part of a year
Protracted means taking a long time.
Correct.
Right? Okay.
Yeah, that's exactly right. Yeah. For the last several months, the better part of a year, I've been hearing how robust the U.S. economy is, how strong it is, how great the labor market's been.
God bless America.
Yeah, God bless America. That being said, I want to kind of talk to you a little bit more about putting that to the test, because obviously these tariffs are going to have an immediate inflationary impact on the cost of goods sold, and just in general for the U.S. consumer. Do you foresee there being a strong default risk when it comes to the U.S. consumer? Because when I'm looking at the indices today, you know, obviously small cap is wildly down because of uncertainty, and that makes sense. But the other thing that's equally as far down as those uncertain pockets of the market is the banking sector. The banking sector is down close to 8 to 10% right now. Yeah. If you look at like Bank of America or some other entities. And I'm just curious, is the general market telling us there's a serious default risk on the horizon?
So I guess maybe we'll just kind of to hit the rewind button and talk about some things that we just keep an eye on, whether there's tariffs going on or not. We always look at the health of the U.S. consumer. A very large portion of the U.S. GDP is driven by consumption. So a healthy consumer matters a lot for us to either, you know, grow positively, to stave off a recession. What we have been seeing over the past I'll call it 6 months, right, before we even got into this tariff discussion, has been a steady increase in the level of delinquencies around credit card debt. Okay, that's something that we talk about on a fairly regular basis. That has not changed. Before these tariffs were announced, that continued to climb to some pretty high and concerning levels. Now, we do believe that impact that will reduce consumer spending. It's going to reduce it in certain pockets of the market where credit card spending is a higher portion of your consumption. That's going to be lower income spectrum of the market, and they're definitely going to feel some additional pain. Now, can tariffs on their own drive you into a default? No, it requires spending. Right, the debts that you've already racked up, those debts don't get larger because you have a tariff. However, it does curtail future spending, right? So if you were typically spending a certain amount of dollars per month and you were able to service your debt, or at least part of it, and on the incremental, you know, you're going to have to spend more per month for those same goods and services. That's going to, you know, create additional stresses, and it's likely going to continue to exacerbate that credit card delinquency problem. When we talk about robustness, we could talk about housing and whether we're going to see any issues on the housing side of things. So one of the other measures that we track to be kind of a proxy of consumer health, but maybe moving up past that lower income level of consumers, is delinquencies, lateness on mortgages, lateness on lines of credit. We haven't seen a big uptick there. So that is reassuring in a couple different ways. Number one is that, you know, not seeing a huge uptick means that those consumers are probably still fairly healthy. You're not going to go if you start to be late on your mortgage payment or late on your line of credit where your home is at risk. Things are going pretty poorly, right? That is definitely a recession indicator. What it also could mean is that there's actually quite a bit of equity left to tap. And so one of the ways that, you know, upper end consumers can weather this tariff storm, if there are surprise increases in prices that do make it through to the consumer, right? And there's no requirement that consumers need to see high prices. Companies can eat those tariffs. Would result in lower earnings, would result in, you know, market multiples coming down and growth coming down on public stocks, but maybe doesn't make it to the consumer, right? There's not a requirement that consumers have to pay this. Likely they'll pay a portion of it. However, if you have untapped lines of credit through your home equity, which I would assume a lot of Americans do have that balance or that ballast that they can tap into, that portion is something that, you know, could help somebody weather the storm. So think about an example of somebody wants to go out and buy a new car. They had budgeted, you know, $25,000 for that car. They were going to put half that money down. The price of that car is up 25%. So maybe that means the car is $10,000 more expensive. That is not a good thing. I'm not going to argue for that being a good thing. However, if you have untapped equity that you can access, that can help you still make that car purchase if you need to, right? Most people would look at the price increase and say, well, I'm going to wait a couple more months and see if it comes back, right? So that's likely you're going to see a decline in car sales if the tariffs go all the way directly through to the consumer.
All right, well, I'm starting to feel a little bummed out. So I want to try to find some silver lining in this. And one of the things we haven't quite addressed yet are rate cuts. And I know that everyone has been trying to figure out when and if rate cuts are going to happen, because inflation is still very much a concern for the Fed. Unemployment is still a relative concern. It's low, but the job market's tightening. And on top of that, you also have these wild, volatile motions in the market, and the Fed is basically sitting there looking at this, and I believe the growth projections moving forward have been, in a significant way, revised down. So do you think rate cuts are more likely, and could that potentially help salvage some of the equity market's returns this year?
Yeah, I mean, the market is definitely pricing in some higher probability of rate cuts now. I think we're starting to see forecasts of 3 to 4 I think earlier this year it was more 1 to 2. So that's increasing a little bit. Whether that will actually materialize, obviously, we don't make a lot of predictions around what the Fed's going to do. However, where you see, I think what the Fed would need to do is they would need to look through one-time upticks in inflation from tariffs. They would need to look through that and say, hey, that is something that's one time. It's not compounded over multiple years. We don't necessarily need to focus in on that, and maybe even allow a little bit more flexibility on the inflation mandate and focus more on employment. Now, employment is still fairly strong. I think we're still at, in that 4.1% unemployment rate. We have not seen government layoffs really make it through in mass to the unemployment numbers because obviously, layoffs take a little bit of time to work out and there's severance associated with it, right? So some of that data is taking more time to work out. So I don't know that the Fed really has a lot of hard data coming through, giving them the flexibility to cut rates based on, typical things that they look at. They would have to kind of look through some of that hard data and get into the more of the forecasting side of things, which they have not been, too keen on that in the past. They've typically been more of a slower to react than quicker to react and less proactive, more reactive. Could they change their tune? Maybe, maybe not. It's probably not something that we're going to stake a lot of money on, though.
Well, Jake, that was extremely informative, and I kind of want to hit a few mountaintops with what people could be doing right now and in the coming weeks to really be able to take advantage of this and just position themselves better moving forward. So I think the first thing to think about is to go through that portfolio, identify some positions that maybe you were holding on to that you don't really want to hold on to that might be down. It could be a great opportunity to harvest those losses and carry them forward when reallocating and just be more tax efficient when a rebound eventually happens. I think the other thing to discuss is that if you've been sitting on cash, which according to studies, there have been record numbers of funds entering money markets over the past year, now might be a good time to slowly dollar cost average into some of those equity exposure or those equity positions that you might have wanted to own but thought were too pricey, right? It might be at a more ideal price point for you and your risk tolerance today, which all connects back to, I believe, timing, right? So we have to think about what our investments are doing, what purpose are they solving? And I think at the end of the day, if you're looking at fixed income, your fixed income is doing very well right now. So fixed income should be positioned to create cash flow for your immediate expenses. But when it comes to equities, what you really want to be focusing on is the long-term time horizon. Don't go all in on equities if you need cash tomorrow. You need to make sure that there's a proper balance and a risk tolerance that you've assessed and that you've implemented when creating your portfolio and your allocation. And that's something I'm sure that you can talk to with our friendly advisors here at Avidian if you have any questions about that.
That's great, Robert. Appreciate that quick recap. Awesome points. I mean, that, in tax loss harvesting, that really is the lemonade of the lemons that we're getting out of the market today.
Yeah.
So hopefully our listeners will take that to heart. I've enjoyed our time today. And even though, things are going, fairly, they're difficult in the markets today, things are volatile. Just kind of understanding, like we've been through this before. We've been through it before as investors. We've been through it before as a company, as a country. And the day is always darkest before the dawn is a good saying to kind of turn to. But generally speaking, I mean, your time horizon is 10 years plus. You don't need to really worry about a single day sell off, right? There are almost no instances in historical observations where equity markets are down 10 years plus, right? So we have time on our side. We like to use that time to our advantage. And anyway, this has been another interesting episode of Ask Avidian. If you guys have more questions, come check us out at avidianwealth.com.